Hey everyone, welcome back to Upside Down Data. Today I want to talk about a new risk indicator that we just launched here on the channel for DOT. So we've put out risk indicators for a bunch of other crypto assets. So we have one for Bitcoin, one for Ethereum, one for ADA, Cardano, one for XRP, and now Polkadot, or DOT for short. And so I'm not going to go into as deep a dive into how to interpret this model. If you want to get more of a deeper dive about that, feel free to go back to one of our earlier videos. We go into a lot more detail in those. But just in brief, what we're looking at on this graph is the price history of DOT across time. And we have logarithmic price plotted here on the y-axis. So each dot represents a day and the price corresponding to that day. And the color of the dots corresponds to the risk level, or the upside downside potential indicators output. That's the name for our risk model. And so higher values, so darker red, closer to 5, corresponds to higher risk, and then darker green corresponds to lower risk. And as you can see from the graph, the UDPI does a pretty great job of identifying these kind of overheated points in the market, these hot zones, and also these low risk opportunities, these times when entering the market would have been historically advantageous, and it usually precedes these big runs that we move to the upside. So one thing that I think is important to note with DOT is that it is a pretty young asset, relatively speaking. You know, it's only been around since 2020, so there's not a ton of data on DOT yet. It just hasn't been around long enough for there to be a lot of price history about it. And so when you're interpreting these kind of risk models, you always have to take that into account to some degree. So for example, with our Bitcoin model or our Ethereum model, you know, I have a lot of confidence in those models because we have a ton of data to look at. Those assets have kind of demonstrated what they're capable of in the past, and there's a lot of data for the model to learn from. But for these younger assets, it's a little bit more uncertainty. You know, these assets haven't been, something like DOT just hasn't really been around long enough for us to have a ton of certainty about what it's capable of doing. Now, it is, I think, remarkable that DOT has been, that the UDPI is able to identify these hot zones and these low risk zones as well as it has, given that limited amount of data. But there's still a little bit more uncertainty around DOT just because it hasn't been around for a super long time. You know, this is the first cycle that it's been in operation through. We're still in the market cycle. You know, Bitcoin just put in new all-time highs, so the market cycle is definitely not over yet. And so it'll be interesting to see how DOT progresses. And so one of the things that I think is an advantage of the UDPI is that for these younger assets, the UDPI is a smart model. It learns from what it's seeing. And so it's going to be taking into account what DOT does from here, and then being able to incorporate that and then build its risk estimates based on that new information, as well as the history of what DOT has been through. And so I think that's going to be useful. And also, the way that I try to build these models, especially for the younger ones, is I want these indicators to really be a leading indicator. You know, it's not useful for it to call high-risk zones after those zones have passed. You really want it to be identifying overheating as it's happening, so you can get a warning that, hey, maybe this asset is running too much, it's overheated, and that's likely to pull back soon. And then you might be able to, you know, start exiting the market or DCAing out of the market in those times. And so that's what happened back here in the spring, where the UDPI really caught, okay, this is getting overheated. It's unlikely for the upside to continue on for much longer. And we didn't really get a move to the downside. There was actually slight still movement up to the upside, but very modest. You know, we're only talking from 40 to, I think the high was around, the absolute highs was around 48. A very modest move to the upside before the big crash. And really, with these kinds of models, you know, if you just rode DOT all the way down from, you know, $5 up to 40, and then it's just hanging out here, leaving money in DOT at that point isn't really doing you a whole lot of benefit. You know, there's other assets that hadn't run yet that your money would have been much better put in other than DOT. And so the way that I use these models is once we get to these really high risk zones, even if the absolute top technically hasn't come in yet, like maybe it will go up a little bit more in the future, it's just not worth the opportunity cost to leave your money in that asset once it's hit these really high risk zones. You're much better off taking profits out of that asset, putting it into something that's lower risk in that moment, and that's where it's useful to have these other risk models like we have at this channel for other assets, so you can identify, okay, if DOT is really overheated, which ones aren't so overheated, which ones have more upside potential left in them, and then you can take your money out of DOT at these points and then move it into those low risk assets and then ride those up as they go up. And that's kind of my philosophy with these markets is I don't care about catching the absolute top of any given assets, in the cycle. I don't care if I sell at 40 when I could have sold at 48 if I wait 3 months. I think my money's much better off in other places during that 3 months rather than waiting for another, $8 move to the upside. It's just not worth it. In the crypto markets when things are regularly putting in, 4x's, 5x's, 10x's, if you just rode something up, like a 10x move like you did in DOT, it's better to move that money somewhere else where you might be able to catch another 10x or another 5x, not just staying in for a move of 40 to 48. That's just really not worth it. And so that's where I think, at least, again, not financial advice, that strategy is just my approach. Make your own decisions, form your own strategies based on what your research tells you. But that's my thinking about how to use these indicators is I don't worry about the absolute tops. I just worry about catching the main parts of the moves and then redistributing my assets to other assets that haven't moved yet that might be able to move to the upside. But then, of course, when these assets flash down here in the green again, that's giving you a signal that maybe things are lower risk now. It might be a reasonable time to be re-entering the market. So again, not financial advice. Form your own strategies, make your own decisions. But those are the things that I use when I'm looking at these indicators, and where it's really useful to have not only an indicator for one asset like Bitcoin or Ethereum, but have these indicators for a variety of assets throughout the crypto space, so that if one's overheating, like DOT did in the spring or like it did again here in September, you can then look and see what other assets are lower risk, and you can make decisions on if you want to reallocate based on that. So just to show this output a little bit differently, like we like to do, we also like to just show what the raw output of the model looks like. So here I've switched it to being a line graph, just as I think with a volatile asset like DOT, I just think it's easier to represent it this way. And we just have the UDPI here graphed on the y-axis, and so the color coding just corresponds to the level, so it's just giving the same information just visually. So 5 being high risk, -5 being low risk, and then again you can see that the UDPI really kind of shoots up at these risky points, and then really bottoms out at these low risk points. So the summer here being the point where the UDPI actually flashes its lowest risk. So there was way more upside potential than downside potential when we were in the summer. And then sure enough, it went from around $10 in the summer, and then it shot all the way up to, over $30. So you would have done a 3x buying here than selling when it got back up to these high risk levels. And currently we're just kind of hanging out here at this a bit overextended level, not as overextended as we were in September, but still kind of up there. So against the US dollar, DOT still seems to be like it might be a little bit overextended. Now, another thing that's important to note, though, with an asset like DOT is that there's going to be fundamental factors that you need to consider that might not be factored into the model because they're new. They're kind of totally new to the asset. And in the case of DOT, the thing to keep in mind currently is the parachain auctions that are coming up. So if you're not familiar with what DOT does, DOT is what's called a layer 0, actually, they say, where it's really a blockchain that's meant for other blockchains to build on top of it. And so the way that will work is through these parachains, where other blockchains, completely separate blockchains, will build on top of DOT, and then there will be this network of parachains that are all linked to the DOT ecosystem, to the DOT blockchain. So that's it in a nutshell. Obviously, it's way more complicated than that. Feel free to look up DOT more to get way more comprehensive information, but that's kind of the way it works. And so these parachains have not been active yet on DOT. They're just launching next month in November. And a lot of people expect that to really increase DOT's price potentially. And the reason for that is that to enter those parachain auctions, the way they work is that people will essentially kind of put their DOT towards a project that they believe in. It's kind of they have these auctions where you lock up your DOT in support of some project, and your DOT will remain locked for as long as that asset, if it wins the auction, would remain in that parachain slot. And then there'll be new auctions down the line as those parachain slots come back up open again, and then people could put their DOT back into those parachain auctions, or they could take them out once they unlock. But because DOT is going to be locked as part of that process, because part of the parachain process involves people locking up their DOT so they can't touch it, they can't sell it during that period, it might mean that there will be a supply shock, there will be a supply squeeze, where there's going to be less DOT out there to trade, and if a huge influx of demand comes in, it could then really drive up the price of DOT. And so it'll be interesting to see what ends up happening, because that's a factor that this model just can't account for, because it doesn't know what's going to happen with these parachain auctions. It doesn't know if that's already priced into the price, and so DOT's not really going to react much from here. It doesn't know if DOT is going to really pump based on that. It's just not sure. So it'll be interesting to watch. Something that I'll be watching for with this model is how it reacts to those parachain auctions and how its risk estimates update according to that. And so one way of interpreting our current level of DOT risk, and that's what I'm showing right here, is that it seems like it could be a little bit overextended against the US dollar, but there is still quite a bit of room to the upside. And so if these parachain auctions really provide rocket fuel for DOT and really send it up, then the idea is that it still does have, according to this model still does allow for it to have quite a bit of room to move to the upside. And so if that happens, we might expect this indicator to flash a lot more risk. And if there is a massive pump like that, it would be kind of expected that there'd be some consolidation or correction or pullback after a massive run like that. So something we'll be keeping an eye on of how the indicator reacts over the next month or so as those parachain auctions happen, and we'll just see how it reacts. So this is the current level. Another thing that we like to do on this channel is also to compare, to not only look at the risk against something like the US dollar, but also look at the risk relative to other relevant crypto assets. And one other asset that a lot of things like DOT, so DOT's a layer 0, so it's technically not the same, but Ethereum is what's known as a layer 1, kind of this base layer blockchain that a lot of other decentralized apps and things like that, other blockchains, or excuse me, other applications build on top of. And so oftentimes DOT just gets lumped in with those other kind of assets, even though it's technically a little bit different. And so it's useful then if you're thinking about, let's say when we're thinking about whether or not to put money into DOT, and they were also thinking, well, is it better for me to put it into DOT or into Ethereum? Then looking at the risk level of DOT relative to Ethereum, so how much is DOT worth in terms of Ethereum, how many Ethereum is one DOT worth, is kind of what this valuation is looking at. Is this really kind of a risky time to be buying DOT instead of Ethereum? Or is this a great time to be buying DOT instead of Ethereum? Can we expect DOT to be outperforming Ethereum or Ethereum to be outperforming DOT in the upcoming future? And so this is the DOT Ethereum valuation over time. So instead of US dollars on the y-axis, we're just plotting the DOT to Ethereum valuation. And as you can see, it is very volatile. So over time, the value of DOT relative to Ether has really fluctuated, and that's because DOT and Ethereum are both volatile assets. They'll move up, against each other. One will move up, one will move down. The other will move up, the other will move down. That just creates a lot of volatility here. But what you can see is that generally speaking, the UDPI does a great job of identifying when the DOT Ethereum valuation might be a little bit overextended. It's kind of on the high end, likely to correct soon. And then when it does correct, then it's pretty great at identifying that this being a lower risk zone where you might be doing better by selling Ethereum for DOT potentially, or acquiring DOT instead of Ethereum in these kind of low ranges here. And then we're currently moving back down to kind of more of a neutral territory here in the DOT Ethereum valuation. So just to show the raw output again of the model, so this is just a UDPI now graphed on the y-axis, -5 to 5. And as you can see, it really spikes up when DOT seems to be overextended against Ethereum, and comes way down when DOT seems to be kind of undervalued relative to Ethereum, when you might expect DOT to outperform Ethereum in the near future. And currently where we stand here is kind of in the middle ground, kind of in the middle. And so really what the UDPI is saying here is that in its estimation, there's not really too much of a difference between buying DOT and Ethereum right now, that each one is kind of equally likely to outperform the other. Moving forward, it's just not really clear if there's an advantage to one versus the other. So it's just kind of, we're in the neutral zone right now. And so, decisions about whether to sell one for the other, for example, you might just be just as well off just sitting there and just not really moving them around between each other. Again, not financial advice. Make your own decisions about these kind of things, but that's just what the model suggests is going on right now, or what the current kind of risk-reward proposition is in the given moment. All right, thank you for checking out the video. If you want more regular updates, be sure to check out our Twitter. We post regular updates about the UDPI levels and about our thoughts about what's going on in the market. Make sure to subscribe for more updates. Give the video a like if you enjoyed the content. And I look forward to seeing you next time. Just remember, with the UDPI, we're all going to make it.